Hello, what if I told you a war unfolding thousands of kilometers away could quietly step into your home? Unbelievable? If this conflict keeps spreading, your gas cylinder, your dal, your job in Dubai, your rent, your EMI, none of it will remain untouched. Let's take a moment calmly without politics or panic to understand what's really happening, what it means for India, and what it means for your family. Some of you may not know what actually happened. On February 28th, 2026, the United States and Israel launched a military operation against Iran. Iran struck back. Within days, the Strait of Hormuz, a narrow 21-mile wide waterway between Iran and Oman, was effectively closed to commercial traffic. You might think, that's far away. Why should I care? Here is why. The strait carries about 20 million barrels of crude oil every day, nearly one-fifth of the world's liquefied natural gas. It also moves the fertilizers that grow your food and the fuel that cooks it. The International Energy Agency called the closure the greatest global energy security challenge in history. Let us know what is India's problem. India imports nearly 85% of its crude oil, much of it from the Gulf, directly through the Strait of Hormuz. When that route shut down, India's energy supply chain didn't just get disrupted, it got structurally shaken. Brent crude, which hovered around 70 to $80 a barrel before the conflict, shot past $117 within weeks, a 60% surge in a month. Petroleum Minister Hardeep Singh Puri described it as crude prices going through the roof. To contain the shock, the government cut central excise duties on petrol and diesel by 10 rupees per litre on March 27th. That move cost the exchequer massive revenue, but without it, petrol would have crossed 120 rupees in major cities. Even so, oil companies are losing roughly 24 rupees per litre on petrol and 30 rupees per litre on diesel. The government is effectively subsidizing your fuel with your future tax money. How about LPG? That's where households feel the heat first. Since 91% of India's LPG comes from the Gulf, the closure broke supply chains. Prices jumped 60 rupees per cylinder in a week. The government even ordered refineries to divert propane and butane from petrochemical production to cooking gas. When oil prices rise, petrol, diesel, LPG all go up, transport costs climb, food prices follow. This chain reaction is called the inflation cascade. The rupee is speaking. To see the war's impact on India in real time, watch the rupee. On March 23rd, the rupee hit a record low of 93.94 rupees against 1 US dollar. By March 28th, it had slipped further to 94.78 rupees, a 4% drop in just 1 month. That might sound abstract, but it's not. Every time the rupee weakens, India's import bill in rupee terms swells. Your cooking oil, your electronics, your medicines, even the parts inside your phone all become more expensive. The rupee under 5. MUFG Research, the Indian arm of one of Japan's largest banks, warns that if oil prices stay above $100 a barrel and the Strait of Hormuz remains blocked, the USD INR exchange rate could touch 95 rupees 50 paise by the end of 2026, and in worst case scenario, even 97 rupees 50 paise or higher. The Reserve Bank of India is fighting back. It has reportedly used 12 to 15 billion dollars from its foreign exchange reserves, intervening across spot, forward, and offshore NDF markets to slow the rupee's fall. Meanwhile, the Sensex and Nifty have both dropped around 10% in the month since the conflict escalated. Foreign portfolio investors have pulled out nearly 1.07 trillion rupees from Indian equities in 2026 alone. For the first time in India's economic history, the balance of payments is projected to remain in deficit for two consecutive financial years. Every $10 rise in crude oil widens India's current account deficit by 0.4 to 0.5% of GDP. With oil hovering near to $120, the math is unforgiving. The global chain reaction is that war is leading to inflation, and inflation may force central banks to raise interest rates. When interest rates rise, home loans become costlier, EMIs increase, business borrowing slows. Already borrowing costs are climbing worldwide as markets price in risk of prolonged conflict. India's kitchen, your thali, what is the effect? This war is not just about fuel, it's about food. And for India, where a large share of household income goes to food, that's a direct hit. Start with something simple, apples and almonds. India imports 23% of apples and 39% of its almonds from Iran. Those imports have stopped completely. Prices of affordable fruits are rising across markets. Basmati rice is another casualty. The Middle East, Saudi Arabia, Iran, Iraq, the UAE accounts for 70% of India's basmati demand. But exporters have been told to halt shipments because insurers won't cover vessels entering the war zone. Indian rice now sits idle in warehouses. Bananas face the same fate. Containers bound for the Gulf are stranded at ports like Kandla as refrigerated carriers refuse to enter conflict waters. Tea exports are also hit. Iran, which buys 15 to 20% of India's tea, is now cut off due to banking sanctions that froze real rupee trade channels. Stocks are piling up in Calcutta and Kochi. And dal, though sourced mainly from Canada and Africa, is now 10 to 15% costlier because the weaker rupee makes imports more expensive. India's private sector activity, measured by HSBC's flash PMI, fell in March to its lowest level since October 22. Companies cite the Middle East conflict, market instability, and rising input costs. Cost inflation is now near a 4-year high. This is your thali, smaller, pricier, and strained by a war you didn't start. You could now assess the effect on your. The 10 million Indians live in the Gulf countries, and work across UAE, Saudi Arabia, Kuwait, Qatar, Bahrain, and Oman. They are construction workers, engineers, nurses, drivers, teachers, domestic workers, and accountants. Together, they send home over $40 billion every year, nearly one third of India's total remittance inflows, which exceed $125 billion annually. This money sustains families, builds homes, pays school fees, and fuels small town economies in Kerala, Uttar Pradesh, Bihar, and Rajasthan. Now that lifeline is under threat, people feel that it is very difficult to survive because one man, two crises, and one war is the situation now. Now, let's see what is the human cost of a Gulf slowdown. When Gulf economies slow because of conflict, Indian workers lose jobs or face wage cuts. When wages fall, remittances shrink. When remittances shrink, families in rural India eat less, children leave school, and women's savings also vanish. Nearly half of all overseas Indians work in the Middle East. MUFG, the Japanese research notes that remittance growth was already slowing due to US immigration pressures, and now a Gulf crisis adds another layer of risk to the most vital income stream for millions of Indian households. MUFG estimates that Gulf remittances alone account for just over 1% of India's GDP each year. A sharp decline would directly hit the rupee's balance of payments already under strain. This is not just an economic data point. These are real people, real families, real lives suspended between a war they didn't choose and a home they are struggling to sustain. India's diplomatic tightrope. For decades, India managed something rare, being friends with everyone. Friends with Iran, a bond rooted in centuries of history. Friends with Israel, a special strategic partnership. Friends with Gulf states, the economic lifeline for millions of Indian workers. And neutral in American wars. That balance is now under severe pressure. Prime Minister Modi's visit to Israel's Knesset in February 2026, just days before the conflict began, drew criticism for symbolically placing India in the Israeli camp at the worst possible time. The International Crisis Group says the fallout has exposed the limits of India's balancing act in West Asia, adding that India has entered more turbulent waters. Meanwhile, Pakistan, India's rival, has emerged as a key back channel intermediary. Pakistan is at the diplomatic table. India, once a regional influencer, is watching from the sidelines. In New Delhi's delayed outreach to Tehran after the strikes, taking days for a senior condolence visit, drew domestic criticism for weakening India's credibility as a neutral actor. The cost is strategic. India's long-standing friendship with Iran, built through history and the Chabahar Port partnership, is under visible strain. And in West Asia, where trust is currency, strain is expensive. India is losing economically and diplomatically in a war it is not even fighting. The growth story at risk. India entered 2026 with momentum. GDP growth was projected at 7.2%, inflation was contained, the RBI was preparing for rate cuts, and foreign investment was flowing in. That story is now in jeopardy. If oil stabilizes between 85 to $95 a barrel post-conflict, not the current $120, economists at Renaissance Investment Managers project capital outflows of 40 to 50 billion dollars or over 1% of GDP. Growth could slow from 7.2% to 6.5%. That 0.7% drop may sound small, but in India, every fraction of growth represents millions lifted out of poverty. If oil stays near 120, the picture darkens. The current account deficit could widen to 3% of GDP, double the baseline forecast. The rupee could slide towards 97 or beyond. Inflation, already near 4-year high, would hit households with full force. The European Central Bank has warned of upside risks for inflation and downside risks for growth, the classic setup for stagflation. India, one of the world's most oil-dependent large economies, is among the most exposed. A growth story built over decades can be shaken by a strait just 21 miles wide. The historical mirror. India has seen this movie before. In 1990, when Iraq invaded Kuwait, India faced an oil shock. Hundreds of thousands of Indian workers were evacuated from the Gulf in one of the largest peacetime operations in history. The balance of payments collapsed and foreign reserves fell so low that India airlifted gold to London as collateral to stay solvent. The crisis forced a 1991 economic liberalization, the Big Bang reform that created modern India. Now, with the 35 years later, India is stronger with $723 billion in forex reserves, a diversified economy, and active diplomacy. But the structural weakness remains: no domestic oil, heavy dependence, and the same choke point. The 1990 crisis lasted months. This one has been building for weeks and shows no clear end. History doesn't repeat, but it rhymes. What India can do and what you can do. India is not standing still. The government has secured a 30-day emergency waiver from the US Treasury to buy stranded Russian oil cargoes, a pragmatic step to stabilize domestic fuel supply. Longer term, every shock like this reinforces what India already knows. That is, reduce oil dependence through renewables, build strategic petroleum reserves, diversify supply chains, deepen energy diplomacy. Those are all policy choices. But what about you? Be financially prepared, not panic. Review your household budget. Identify where energy costs hit hardest: fuel, LPG, imported goods. Plan for 3 to 6 months of elevated prices. In case your family has got connections with Gulf, stay connected with the family in the Gulf. Understand their job situation. Have a plan if contract ends or wages are delayed. Keep emergency funds ready. If you are an investor, Stay rational. Aviation, paints, chemicals, and logistics face margin pressure. Upstream, oil producers may fare better. Avoid impulsive equity moves. Watch the rupee and RBI signals. If the RBI cuts rates despite oil pressure, markets may rally. If it holds or hikes, inflation is becoming entrenched. Please understand this. Support local produce. Buy Indian fruits, vegetables, and grains. Cushions you from import shocks and supports farmers under stress. The final line: war may not reach your city, but its consequences already can. The smartest people don't react to crises, they prepare before they hit. Friends, this is a very lengthy and useful video produced with a lot of pains. And if you found this useful, subscribe to the channel and also share it with your friends because the consequences affect everybody in our society. Thank you very much.